Inflation, in its simplest terms, refers to a general increase in the prices of goods and services within an economy over a period of time. This economic phenomenon is typically measured by tracking the changes in the price level of a basket of consumer goods and services, often referred to as the Consumer Price Index, or CPI. As the price level rises, each unit of currency buys fewer goods and services, effectively reducing the purchasing power of money. One of the primary causes of inflation is an increase in the money supply. When the money supply grows faster than the rate of economic growth, it can lead to inflationary pressures. This occurs because there is more money in circulation chasing the same amount of goods and services, driving up demand and subsequently prices. Governments and central banks play a crucial role in managing inflation. Monetary policy, which involves controlling the money supply and interest rates, is a key tool used to influence inflation. By adjusting interest rates, central banks can encourage or discourage borrowing and spending, thereby impacting the overall level of economic activity and, consequently, inflation. Understanding inflation is essential for individuals, businesses and policymakers alike. By comprehending the causes and consequences of inflation, we can make informed decisions about our finances, investments and overall economic well-being. Throughout history, inflation has played a significant role in shaping economies and societies. From the hyperinflation of Weimar Germany in the 1920s to the stagflation experienced by the United States in the 1970s, the consequences of inflation have been both profound and far-reaching. One of the most notable examples of hyperinflation occurred in Germany after World War I. The government's decision to print excessive amounts of money to finance war reparations and stimulate the economy led to a rapid depreciation of the German mark. Prices soared astronomically, rendering savings worthless and plunging the country into economic chaos. In the United States, the 1970s witnessed a period of stagflation, characterized by high inflation, stagnant economic growth, and high unemployment. The combination of these factors created a challenging economic environment, leading to a decline in living standards for many Americans. These historical examples highlight the destructive nature of inflation. When prices rise rapidly and uncontrollably, it erodes the value of savings, reduces purchasing power, and undermines economic stability. Understanding the historical context of inflation provides valuable insights into the potential risks associated with this economic phenomenon. Purchasing power parity, or PPP, is an economic theory that compares different countries' currencies through a basket of goods approach. This method allows economists to determine the relative value of different currencies by comparing the cost of a standard set of goods in each country. According to this concept, two currencies are in equilibrium, or at par, when a basket of goods is priced the same in both countries, considering the exchange rate. This equilibrium helps in understanding the true value of currencies beyond just their market exchange rates. PPP is an essential metric for economists and investors as it provides a more realistic comparison of living standards and economic well-being across different nations. It helps in making more accurate economic predictions and investment decisions. For instance, let's consider a hypothetical scenario where a basket of goods costs $100 in the United States and 80 euros in Germany. This comparison helps in understanding the cost of living and purchasing power in different countries. Assuming the exchange rate is $1 equals 0.8 euros, the PPP exchange rate would also be $1 equals 0.8 euros. This parity indicates that the currencies are fairly valued against each other. This implies that the purchasing power of $1 is equivalent to that of 0.8 euros in Germany. It shows how much goods and services one can buy in different countries with the same amount of money. However, if the exchange rate fluctuates, say to $1 equals 0.75 euros, then the US dollar would have a weaker purchasing power compared to the euro. This fluctuation can impact international trade and investment. PPP plays a crucial role in international trade and investment decisions. It helps businesses and investors to evaluate the true cost and value of their investments across different countries. Businesses and investors use PPP exchange rates to assess the relative values of goods, services and assets across different countries. This assessment is crucial for making informed financial decisions. Furthermore, PPP helps policymakers understand the competitiveness of their economies in the global market. It provides insights into how their currency stands against others and what measures can be taken to improve economic stability. By comparing price levels and adjusting for exchange rates, PPP provides a more accurate picture of economic realities than nominal exchange rates alone. It helps in understanding the real purchasing power of different currencies. Understanding PPP is vital for individuals, businesses and policymakers to make informed decisions in an interconnected global economy. It helps in planning and strategizing for better economic outcomes. It provides valuable insights into currency valuation, cost of living comparisons, and the overall economic health of different nations. These insights are essential for making sound economic policies and investment strategies. Section 4. Inflation's impact on savings, the erosion of value. Inflation can significantly impact savings, eroding the value of money over time. This gradual loss of value can have serious implications for long-term financial planning. When prices rise, the purchasing power of savings diminishes, meaning that the same amount of money buys fewer goods and services in the future. This can make everyday expenses more challenging to manage. This erosion of purchasing power is particularly concerning for individuals who rely on their savings for future expenses, such as retirement. It can lead to a significant shortfall in expected income. For example, if an individual saves $100 today with an annual inflation rate of 3% in 1 year, those savings will have a real value of only $97. This small percentage can add up over time. This means that the purchasing power of the initial $100 has decreased by $3 due to inflation. Over time, this effect compounds, further reducing the value of savings. Over longer periods, the impact of inflation on savings becomes even more pronounced. The longer the money is saved without earning interest that outpaces inflation, the more its value erodes. To mitigate the erosive effects of inflation on savings, individuals can consider various strategies. Consulting with a financial advisor can provide personalized advice tailored to individual needs. One approach is to invest in assets that have the potential to outpace inflation, such as stocks, real estate, or commodities. These investments can offer growth opportunities. These investments can provide a hedge against inflation by generating returns that exceed the rate of price increases. Diversifying investments can also spread risk. However, it is essential to note that all investments carry inherent risks, and their performance is not guaranteed. It's important to understand these risks before investing. Another strategy is to explore high-yield savings accounts or certificates of deposit, also known as CDs, offered by financial institutions. These can offer more stable returns. While these options may not always outpace inflation, they generally offer higher interest rates compared to traditional savings accounts, providing some level of protection against the erosion of purchasing power. It's a safer, albeit less lucrative option. However, it's crucial to compare interest rates and terms from different institutions to ensure the best possible returns. Doing thorough research can make a significant difference in preserving the value of savings. Section 5. Investments and inflation, seeking higher returns. Investments play a crucial role in mitigating the impact of inflation on one's financial well-being, ensuring that your money retains its value over time. When inflation rises, the purchasing power of cash diminishes, making it essential to invest in assets that have the potential to outpace inflation and generate real returns. This is crucial for maintaining your standard of living. Stocks, representing ownership in publicly traded companies, have historically outperformed inflation over the long term, providing substantial growth opportunities. Investing in stocks allows individuals to participate in the growth of corporations and potentially earn dividends. providing a hedge against rising prices and contributing to wealth accumulation. However, it's important to acknowledge that stock markets are inherently volatile and their short-term performance can fluctuate significantly. This volatility can be daunting for some investors. Bonds, representing debt securities issued by governments or corporations, offer fixed interest payments and the return of principal at maturity, making them a more predictable investment. While bonds generally provide lower returns compared to stocks, they are considered less risky and can act as a stabilizing force within a diversified investment portfolio, balancing out more volatile assets. Real estate, encompassing residential, commercial and land investments, has also demonstrated its ability to hedge against inflation, offering both income and potential appreciation. As prices for goods and services increase, so too do property values and rental income, potentially outpacing inflation and generating real returns. This makes real estate a valuable component of an investment strategy. Commodities, including raw materials such as oil, gold, and agricultural products, can also serve as a hedge against inflation, providing a tangible asset that often rises in value during inflationary periods. During periods of rising prices, commodity prices tend to increase as well, making them an attractive investment option for investors seeking to preserve purchasing power and diversify their portfolios. It's crucial to note that all investments carry inherent risks, and their performance is not guaranteed. Understanding these risks is essential for making informed investment decisions. Diversifying investments across different asset classes is essential to mitigate risk and enhance the potential for long-term returns. A well-diversified portfolio can weather various market conditions. Consulting with a financial advisor can provide personalized guidance based on individual financial goals, risk tolerance, and investment horizon, ensuring a tailored approach to achieving financial success.